Average VantageScores declined 1 point in December and 2 points for the year. Number of VantageScore subprime borrowers grows as the number of prime borrowers shrinks. Overall delinquencies tick higher across all payment stages. Things are getting increasingly volatile in the consumer credit markets. I'm Jeff Richardson, host of Credit Gauge Live, and welcome to the January 2026 edition. As always, I'm lucky to be joined by my colleagues, Susan Fay and Atif Mirza, our lead Credit Gauge analysts. Atif, first question to you. We talked about the average credit scores. How are consumers doing in terms of their scores overall?
Thank you, Jeff. When we look at credit score, the story in December is that the pressure is building gradually on consumers. Average VantageScore credit score dipped about 1 point to 700 and from November, and about 2 points from a year ago. Now, this is a smaller shift, but it tells us that there is a modest softening among consumers from a credit health perspective.
Thanks, Atif. Susan, I want to peel back the layers on that just a bit and look at where there's shifts in the credit tiers. What are you seeing within the consumer credit tiers?
Thank you, Jeff. This month, the number of borrowers in the VantageScore subprime credit tier grew, while the prime tier actually contracted. Over the 2-year period from December of 2023 to December of 2025, we saw the share of consumers in the VantageScore subprime segment increase from 18.5% to 19%, while the near prime segment edged up as well. However, when we look at that same period of time, that same 2 years, the VantageScore prime credit tier actually declined 1.1%. And what this trend shows us is that it indicates there's a gradual migration of consumers to lower credit score tiers, and this is reflective of the ongoing affordability pressures that consumers are facing currently.
Interesting, Susan. So my guess is delinquencies have something to do with this. Atif, question over to you. How are consumers doing with their payment obligations?
In December, we did see some pressure building among consumers and how they're handling their payments. Overall delinquencies rose both month over month and year over year across all stages, especially the late stage where delinquencies grew about 45% year over year on a relative basis. And especially when you look at from a product perspective, mortgages stood out because mortgages late stage delinquencies, they rose about 18.6% year over year on a relative basis. That's important, Jeff, because it tells us that this stress isn't emerging, it's actually persistent.
Thanks, Atif. Thanks, Susan. This is not necessarily how we wanted to start the year. It's a lot for lenders to unpack. The good news is that we're going to bring in a special guest who's going to help lenders make sense of these trends and understand what they can do. Joining us this month for the first time ever is the VantageScore President CEO, Silvio Tavares. So you won't want to miss it. We'll be right back. Welcome back to Credit Gauge Live, and today I am so pleased to be joined in person by Silvio Tavares, President and CEO of VantageScore. Silvio is one of the most trusted consumer credit and data analytics executives in the industry, and someone who's focused every day on how lenders can make smarter decisions in a rapidly changing market. Silvio, first question to you. This is your first Credit Gauge Live appearance. This is a hardball question. What took so long?
Thank you, Jeff. Well, I was waiting for the invite, but now that I've been invited, it's a real pleasure and honor to be with you here in New York City on Credit Gauge Live. Thanks for having me.
Well, we're thrilled to have you, particularly right now, because all kidding aside, we are seeing a lot of mixed signals out there, shifting consumer behaviors. We just spoke with Susan and Atif about increasing delinquencies and a reduction in the average VantageScore credit score. Lenders need to make faster, better decisions. So I can't think of anybody better to be a guest this edition of Credit Gauge Live. So first question, how should lenders interpret today's economic signals, and what are the implications for a lender's use of data?
Well, it's a great question, and the reality is there are a lot of mixed signals. On the one hand, you have affluent Americans really spending with wild abandon. It is very much a tale of two cities where wealthy Americans are spending and borrowing, and everyday Americans are feeling much more challenged by the economy. It is, in fact, the proverbial K-shape. And if you look at the averages across the entire population, sometimes it sends a false signal. And so the key for lenders today is they really have to recognize that they have two distinct sets of customers with two distinct needs. Affluent consumers are looking for larger lending. They increasingly are very credit worthy. The average consumer is more challenged, and many of those are becoming a much more marginal, risky consumer. And so this is a time to know both audiences, but also to invest in the best data analytics so you can discern between those two and make the right decisions when it comes to lending. One key data point that's really important is looking at the overall average VantageScore credit score, as well as looking at the scores for specific segments. And if you look at it on a full year basis, as you look over 2025, the average VantageScore actually declined by 2 points, starting at 702 and ending the year at 700. And what that masks is the fact that actually the super prime and prime consumers moved up and became more credit worthy, and a lot of the folks below that prime tier, that total tier, increased in size, more consumers there with lower average scores. So that's the story. It's a tale of two cities.
There's some bifurcation there. You spoke about the credit scores. I want to just sort of dig in a little bit further. When we talk to lenders, and we talk to the largest lenders and risk managers in the marketplace, what do you see as the biggest misconceptions about credit scores?
Well, you're right. We do speak to the largest lenders. You may be able to see over my shoulder here the Bank of America Tower here in New York City, one of the largest banks in America. Right behind that, you'd see the new JP Morgan Chase Tower, the largest lender in the nation. And, if you think about banks, they tend to be traditional. They tend to be risk averse and try to focus on doing what they have done in the past. Part of that is they're highly regulated businesses, and so they can't change too many things at once without creating focus on them by regulators. But the biggest misconception that many of the leading lenders have is using an old, outdated credit score is a good choice for the future. It's a big mistake, because the reality is outdated credit scores that don't look at the relevant data at the right time and don't use the most advanced analytics, those credit scores are doomed to failure. And many times, if you use that old legacy credit score, it's going to give you a false read on the credit quality as you do your lending. And so that's the biggest mistake that we see big lenders doing, is not switching to innovative credit scores like VantageScore that use the best data, including our alternative data, and the best, most modern analytics techniques.
So it's a perfect segue to my next question. Of course, the mortgage industry has made that decision. They've chosen to use VantageScore 4.0 in mortgage lending, beginning immediately. That was the big story of last year. So what they are expecting, interest rates could potentially decline, new score, there could be a refi wave. Everybody wants to capture that business. So my question to you, how do lenders take advantage of that, prepare for that, but also not repeat some of the operational and credit mistakes in the last cycle?
Yeah, well, it's a really, really big opportunity in 2026. If you look at how much money large lenders, particularly in the mortgage space, are going to win, how much money, new money they're going to save, that number is a big number. It's over $600 million in 2026 that the largest mortgage lenders can save by switching from the legacy score to VantageScore 4.0. So the first thing I would just say is large mortgage lenders, take advantage of that opportunity. It's a unique time when you can actually make such a significant savings by switching. The second key thing I would say is that there is a big push by America Incorporated to shrink the wealth gap and enable more consumers to get into their homes. the dirty little secret of mortgage lending is that many credit-worthy consumers were locked out of the system due to these outdated credit scores. That has been fixed now with VantageScore. And so many of these lenders are going to be able to lend to literally millions more credit-worthy Americans. We expect that's going to be $1 trillion in incremental mortgage activity. And so you got to staff up. We know that interest rates are on the way down as a result of a number of the decisions made by the administration and Congress. We know that mortgage rates are on their way down. And as a result, many consumers are going to want to take that once-in-a-lifetime chance to get their first mortgage, and they want to do it using VantageScore. So big opportunity for savings, over $600 million in savings on the table. Number two, big opportunity for revenue growth for lenders by capturing incremental consumers. We expect over 33 million more consumers will have a credit score, and about 5 million of those consumers are actually going to be able to qualify for their first mortgage and get into their first home and start living their American dream.
It could be a huge year for a number of large mortgage originators to take advantage of those trends. So the other thing that we observe is increasingly lenders want to be connected with their customers. How can lenders do that and ensure that they stay within their ecosystems, within their platforms?
Well, for consumers, they want to know about their credit score. It's just that simple. Having a credit score and knowing what your credit score is the key to financial well-being for most Americans. The number one question that I get asked when someone finds out I work in the credit scoring industry and I'm the CEO of a credit scoring company, the first thing they ask me is, how can I improve my credit score? And what I tell them is, you can't manage what you can't see. I tell consumers the first thing you should do is know your credit score. Have a place where you can check it. And what I would say to lenders is, if you are not displaying your consumer's credit score on your digital platforms, that could be your online banking app, your online website. If you're not doing that, you need to be. That's the biggest way that you can engage your customers, and it's the pathway to them using your bank services more broadly. Many of the leading companies in consumer display for credit scores are VantageScore customers. JP Morgan Chase, the nation's largest bank, when you log on to their online banking portal, you see a VantageScore credit score, not our competitor's score. If you open up your Credit Karma app, which is the leading financial well-being app, if you open up that Credit Karma app, you don't see our competitor's score. You see a VantageScore. So the key is engaging with your consumers, providing them the tools to live their best financial life, and that starts with displaying your VantageScore.
That is excellent advice, and thank you for the answers to the other questions. Quite a treat for us at Credit Gauge Live to have you in. Thank you for being here, and let's have you back as soon as possible.
Thank you, Jeff. I really appreciate it. This was a lot of fun. Thanks for having me on.
Thank you all for watching the January edition. In the meantime, you can visit VantageScore.com to download the VantageScore credit gauge analysis and use the tool. Until next month, I'm Jeff Richardson. We'll see you then.